Hey guys, welcome back to the channel. In today's video, I want to talk about something that I've been seeing a lot of, especially in the high yield space. There's a lot of communities talking about this, a lot of YouTubers that were talking about this, and it's this whole idea that you basically purchase treasury bills as your core holding, right? And you purchase these treasury bills as your core holding, and then you take margin against them to invest into either a cover call ETFs, income ETFs, high dividend yield ETFs, or stocks or whatever else, right? And while that idea might have some merit, that idea might sound good on paper. I think if people dig a little deeper and they understand the mechanics of how these treasuries work, they'll come to find out that this is probably a very moronic idea. Now, it does make sense in some ways. It really does. The idea does have merit, and it depends on the investor, right? It always comes back to the investor and what are they comfortable with? Are they comfortable with a lot of risk? Are they comfortable with volatility, or are they not? Right? If they're not comfortable with volatility, then they'll probably want something like bonds or treasuries where the price is very stable. So we're going to talk about all of that. And I'm going to just give you, again, my thoughts on it, because I really don't think for the by and large majority of investors who are in either the high yield space or, the income investing space, or even, the growth type of, investor, I don't think treasuries makes a whole lot of sense. So let's get into it. So this is my portfolio today. Obviously, we're in the green. We've had a crazy week. All right, almost 2 weeks now. It's been absolutely crazy between the geopolitics, the tariffs, possible conflicts abroad, and everything else in between. It's just been a very chaotic week. And this portfolio was not spared from any of that. But luckily, because I am, stacked correctly with margin, I still have about $31,000 or 42% to go before I would face a margin call. So when we were getting hammered in the markets, this was obviously very scary. I saw this drop down to close to $20,000. And if we continued on a downward trend, I would have to sell stuff. But, thankfully it never got to that. So, we just kept on trucking. But anyways, let's get into this whole SGOV stuff. But before I do, I just want to let everybody know I am launching my own Discord. All right. The link will be down below in the description, as well as the first comment pinned to this video. You can also check out my posts. All right. This is a brand new community. We're going to be talking about not just stocks or income investing or high yield investing. We'll be talking about stocks. We'll talk about real estate. We'll talk about, personal finance. It's just going to be an overall great type of community. So if that's something that you're interested in, please come join us. All right. Enough of that. So let's talk about this whole 0 month treasury bond SGOV. All right. This is the one that's the most popular. This is the one that's been making its way around on YouTube. And a lot of people are saying, hey, why don't we just invest? We're going to take a number. Let's say $10,000. We'll take $10,000 because I know that's what most investors typically have. You can even go as high with 50 or 100, right? It doesn't really matter, right? But most investors are saying, hey, why don't we just invest into SGOV and then take margin from it to invest into high income ETFs, things from Yield Max, things from NEOS, things from Roundhill, or anyone else in between. So this week, right, from Roundhill has also been making its way around. Now, this doesn't have enough performance data for me to actually use it. So I'm going to use SGOV because this is essentially what this is. This is, Roundhill's SGOV, variant. It's no different than, SPY or VOO. It's just another flavor of, an ETF, right? And, you get weekly distributions, which I guess would, kind of excite people. But, when you look under the hood, the distributions aren't exactly, exciting. You get, cash alternative. And I would agree with this. You would put your money in this versus, like a savings account, or if you just have money sitting in a bank account and, it's not collecting any type of interest, then this would be a good idea, right? This or SGOV would be a good idea. And really they're touting for the stable NAV, right? So let's look real quick at the iShares 0 to 3 month treasury bond ETF SGOV. So real quick, you guys already know, this thing is going to be paying you about 4.25% ratio, or I'm sorry, 4.25 on a dividend yield. The expense ratio is 0.09%. Not exactly, too bad. This came out in 2020. All right. So I want you guys to keep this date in mind because this is important to the story. So this came out in 2020. It was going to be, giving you a distribution monthly. Okay. And this is the mechanics of these treasuries. The treasury, the underholding treasuries, they have to mature. They usually mature every 3 months or every month, the way they have them stacked in these funds. And then when they mature, usually you're going to get some type of yield, and then they distribute these yields off to the investors. But look at this. The 30-day SEC yield is 4.18%. Okay, now this might be exciting, especially when, you're not really doing anything. You're not really actually having to manage this or anything like that. So, 4% is not bad. Definitely not bad. It beats out a lot of stocks out there on the market. It's very close to SCHD. But the thing is, you're not going to exactly get growth when you invest into these treasury ETFs. You're not going to get any type of growth. All right. No share price appreciation. But that's also, a pro of these is that they're not very volatile. They're not volatile at all. So again, we look at, week, this came out and a lot of people were like, okay, so this whole idea, hey, let's buy week. Let's buy it with, $10,000, $50,000, $100,000, and then we will take margin in order to buy our other ETFs, right? We're going to follow this concept of margin stacking. Again, that's not something I came up with. You can look up Oracle ETF if you want the full gamut of how that works. I'll show you a visual of what it looks like later in this video. But basically, people want to follow this whole idea of margin stacking, right? Or they want to follow something called an ETF stack where, they'll put this at the bottom, 25%, maintenance requirement, and, then take out their margin. So let's look real fast. I just want to take you down memory lane. Okay. So people are all excited about this. They're saying, we can invest the money into SGOV and then we'll use the dividend yield to pay off the interest from our margin. It sounds like a smart idea on paper. Right? Sounds like a great idea on paper until you start looking at the mechanics of this. Okay. So let's zoom out 5 years. This came out in 2020. Okay. So this came out in 2020. Look at what happened here. Do you guys know what this is? Most of you don't, because this right here back in March is when the Federal Reserve started hiking interest rates, which caused these shares to go like this. Right. And that's when they started paying out a dividend yield. Okay. So you have to keep that in the back of your mind, that the only reason why it's at 4.37, 4.18% for a dividend yield is because the federal funds rate increased over time. Right. And now we're on this federal funds rate decline where we're trying to get the interest rate down. So what do you think will happen to this interest rate? This won't even cover the margin costs that you take out against this. If you're using Robinhood, M1 Finance, or anyone else, even Webull, I don't think you're going to be able to cover the cost of that margin. So you're actually going to be already in the negative once you try to implement this idea. Okay, so just keep that in your mind. Okay, this came out right after the Rona, and the interest rate was almost near zero, so nothing exciting there. So will we go back to a 0% interest rate environment? Very doubtful. But will this interest rate decrease over time? Yes, it will. And you can look here in the dividends. And if we look at the dividend history, you guys can see it's already starting to decline. And as we continue to lower the interest rate, the Federal Reserve continues to lower the interest rate, and the Treasury yields continue to drop, then these will obviously start to drop as well. So now you're basically operating in the negative. You're operating in the red. You're not making any cash flow from SGOV. Yes, it's $1 is going to be $1 in the future. $1 bought today will be $1 in the future, sure. But this is the whole idea of using this as part of your margin stack is not intelligent in my opinion. It's just my opinion, of course. If there's anyone out there that wants to debate this fact, please put it down in the comments. I'd love to hear your thoughts. I could be completely wrong about this, but based on everything I know and everything I've seen and read, the idea is not as sound as some people might think. All right. So again, if we start lowering interest rates, these will start to drop, and these could drop substantially. Okay. So this is just a quick timeline of when the Fed started hiking. Okay. In March 2022, the Fed made its first interest rate increase since 2018, raising rates from 0% to 25 basis points to the level of 25 to 50 basis points. Inflation peaked at 9% in June of 2022. In July of 2023, the Fed made its final 0.25% increase, bringing the rates to 5.25 to 5.5%. So that is what is accounting for all of this. But as you guys know, we've been lowering interest rates since last year. So this will steadily start to decline over time. So this is just a chart of margin. Now, most of you may not have up to 100K in investable money, to take out margin. So we're going to go with 5.75%. You can even use 5.5% if you'd like, right? You can look and shop around with Webull, or shop around on M1 Finance or Fidelity or whoever else, right? The margin rates, or even Interactive Brokers, the margin rates are going to vary from broker to broker, but this is just to give you an idea. You are net negative every time you have to pay the interest bill. SGOV is not going to pay you enough money in dividends or in yield or distributions in order to cover even the margin rate for that. So you have to just keep that in the back of your mind. All right. You're actually losing money. If you do the math, it just doesn't work out. Okay. It just does not work out. So why wouldn't you want to use this, week, or even this for your, stack, right? For your core position, because you're giving up opportunity. There's a huge amount of opportunity that you're giving up when you do that. If you look at the S&P 500, yes, over the last 5 days, it's been absolutely brutal. Over the last month, it's been absolutely brutal. Over the last 6 months, it's been absolutely brutal. We're down. At one point, we were down almost 19%. We're basically down 20%, right? And then it looked like we were actually going to go further down, right? This could have been catastrophic. We could have went down to 30%. Whereas people who invested in Week or SGOV, yes, they would have maintained their dollars. It would have been fairly steady. Again, you're not really making any money here. You're making less than 30 basis points, which again is not bad. I mean, you're actually stabilizing your money. But what happens when this recovery happens? What happens when the S&P 500 recovers, right? If we look, at 2021, right, when the market started taking a downturn, right, we like hit our lowest in October of 2022, and that was a 24% decline. Now, if we look past that and see the recovery, you could see that over a span of 3 years, we were just on a steady growth trajectory. Okay, we had a 70% increase in gains. Now, if you were to follow this whole idea of buying Week or buying SGOV and then taking out margin against it, right, to thinking you're like a investing savant, you could potentially be giving up all of these gains, 70% worth of gains. Imagine that. If you had $100,000 in SGOV, you'd be giving up close to $70,000 in gains. That 4% is not going to make up that amount of money that you're going to lose or miss out on, is the better term. So yes, in the short term, this is very, very scary. In the short term, this is worrisome, a lot of fear in the markets, etc. But again, this is the cost of admission. This is the price of admission of being an investor, of getting outsized gains over long periods of time. So again, we look at SGOV. Now, let me show you this whole margin stack thing, because some of you guys may not be aware of it. So in the high yield space, there's this prevailing thought that you can invest a lot of money, into any holdings, right? People were buying anything. And then they were taking margin against them, right? They were buying a lot of, 60+% maintenance requirement ETFs, and then taking out margin against them. And then when these, spiked, or the value of these ETFs dropped, or their portfolio dropped, they were getting margin called left and right. So you don't want to be in a margin call. It's very crappy, because you're going to have to sell shares at a loss, right? Not only are you going to have to sell shares, it just amplifies your losses. Okay. Remember, you don't lose money until you sell, which is, it's the honest truth, because you can always wait for these things to recover. But, if you're in a margin call and you have to sell and you're already down on the portfolio, well, you're going to amplify your loss, because now you're selling shares for cheap and then you have to pay this debt back. So again, you're amplifying your loss there. So the idea behind this is, it's a 25% maintenance requirement. We'll just buy SGOV, right? And put it all the way at the bottom. This would be the core holding. And again, this is no textbook answer stuff. This is, all like Fugazi, this is all made up. All right. This whole margin stack concept is completely made up, but it is a sound concept and it does work. You guys can see it from my own portfolio. I am margined, to the tits. I'm margined to the tits. I don't know how else to say that. And I was investing in one of the most brutal times that you can invest in, and that is a downward spiraling market, right? Basically a bear market, right? And I came out fine. I came out completely unscathed, didn't get a margin call. So let me get back to this real fast. So the idea is to do this SGOV, right? And then people will buy any other type of ETF, right? Maybe they will buy 25% maintenance requirements. And this is my point. If you're going to do that, if you're going to do a margin against SGOV, make sure you do it intelligently. Make sure you're not just YOLOing the cash and buying these, really NAV eroding, share price declining ETFs that might be paying you out a high yield, a high distribution rate, but the price of those ETFs are going down, right? I'm not going to say which funds do this. A lot of them do pay out a high yield and they give you maximum amounts of distribution. So, you guys can figure that one out for yourself, but you have to be very careful, because what will happen is, let's say you're invested in a ton of these ones, right? And the way you find out where that is, what that maintenance requirement is, like if we look at XDTE, which is from Roundhill, and if we scroll down a bit, you can see right here, it tells you what the maintenance requirement is, right? It's 25%. On M1 Finance, they tell you what it is, and it varies from broker to broker. Here on Robinhood, it's 25%. On M1 Finance, it's 45%. And surprise, surprise, these can change. They can change. They can go from 25% to 30%. They can go from 25% to 100%. It all depends on the actual ETF and what Robinhood or the broker decides. Okay, PLTW is a ETF for Palantir that I invest into. This used to be 100%. And then only recently, when we were in a spiral downward, trajectory in the markets, did they lower it to 30%. I don't know why, but I was happy with that. It gave me more buying power. So you have to be, again, very careful what you use your margin for and how you actually construct your portfolio with margin. Now, again, there is some merit to using these. There is some merit, and it depends on the investor. Do you want volatility or not? Do you care about it or not? Or, what's your long-term investing horizon? All these other questions you have to answer for yourself. But to just think that this is the best strategy, I don't think so. Because you're giving up so much opportunity cost. You're going to miss out on all of the gains, all of the potential gains. And not only that, by taking margin out of this, you're already in the red, depending on how much your margin interest is. Okay. Even if you look at the S&P 500, and again, if we scroll out a bit, you're going to give up all of these gains. And even with something like an XDTE or even a SPY-I, I know SPY-I is a pretty big one out there. A lot of investors invest into this. You'd be giving up all of those gains as well. Look, even 9%, and it spits out I think it's like a 10 or 12% distribution yield. So you'd be giving all of that up when you invest into SGOV. If anything, SPY-I would probably be a better candidate than SGOV, in my opinion. At least the monthly income would offset the interest that you have to pay, right? And it's a 25% maintenance requirement ETF. So that is going to do it for me, guys. I just wanted to kind of just shed my thoughts on all of this because, again, people I don't know if they don't study history or they weren't investing way back when. But I remember when SGOV came out, And I remember looking at this thing and I was like, this is, my thoughts didn't change. It's like, this is for the investor that, has a lower risk to volatility. They don't want to deal with the volatility. Maybe they're closer to retirement. They're a little older. They don't want to have their money in higher risk assets like equities. So yes, this makes perfect sense, right? But then you stack on margin on top of this, and your risk profile goes even a little higher, because what if you're investing into, other ETFs that are, yes, they might be spitting out high distributions, but their NAVs are completely eroding, right? You're not going to be able to live off those dividends. And all it's going to take is one more market downturn, which, they come every 10 years or so. Bear markets come every 3 years or something, or not bear markets, market corrections, which are 10% drops. They come every 10 years. Imagine if you were stacked like crazy with nothing but these, right? Or even some of these in the middle, and you start getting margin called. Well, where are they going to take the money from? SGOV. They're going to take it from SGOV. Okay. So this is why, again, you got to be careful with how you use margin, what you invest into, and then how you use it. I'm not saying SGOV is bad or anything like that. I just want to kind of wrap this up with what you're giving up here. Okay. So what are T-bills good for? They're good for short-term cash holding positions. Okay. If you're just going to have some cash, you don't want to keep it in a bank account or a piggy bank or under your bed, then yes, T-bills make a lot of sense. They're, recession and volatility hedges. Okay. Right now there's all this news about the United States going into a recession and all this volatility and et cetera, all that other stuff. This T-bills would be a good choice for that, for the investor that wants to kind of smooth out the waves. Okay. And this is obviously going to be better than a savings account over long term. At one point in 2018, the average savings account was about 1.8% to 2.2% interest on your money, right? That's a joke. Inflation was eating your money alive, right? So T-bills could probably be a little better than that. And then, you're going to get account stability, which is a big one, especially right now. Again, we're just in the short term. This is all short-term stuff, people. Okay. We're dealing with all this volatility, the ups and downs, the crazy swings because of what's going on in the broader market, the broader, world, the global stage. We have essentially countries going crazy over what we're doing, right? What the United States is doing. Okay. But when you invest into T-bills, you're giving up share price appreciation, right? Which we covered, the potential for higher priced ETFs to increase in value, right? You're giving up opportunity cost. You're right. You're gonna suffer an opportunity cost, because you could just put your money into something like SPY or the S&P 500, and you would recover, and then on top of that, any dollar after that is going to be pure profit. So you got to make the best decision for yourself. There's nothing saying you can't invest half into SGOV and then half into something else. There's nothing saying that you have to do anything, right? I'm just saying that I've been seeing this a lot, and I think investors are kind of missing the mechanics of how these treasury yields, or how these treasury actually work, these treasury ETFs. So hopefully this video was very educational, informative for you, and you got some type of value. Again, if you want to join the Discord, the link will be down below in the description, as well as the first comment pinned to this video. I hope you guys enjoyed this video, got a lot of value, and I will see you in the next video. Take care.